Good afternoon, ladies and gentlemen. Welcome to the weekly economic update, normally on a Monday, on a Tuesday, July 5th, 2022. Hope everybody had a fantastic holiday weekend. It was a little warm here in Colorado. It was up in the 90s yesterday here at my house and was a little toasty on the main floor upstairs. Stays nice and cool down here in the lower level, but upstairs it was hot. So didn't get a lot of chores done, unfortunately. I did get some vacuuming and things like that done over the weekend. But anyways, like I said, hope everybody had a great weekend. Hope everybody's got all their fingers still and didn't blow them off with some firecrackers. That would have been really, really bad. So new week, about the same old ugly markets. There was one standout. The NASDAQ looked pretty good today. But, all the other equity markets looked pretty crappy. So, all right, well, let's go ahead and jump in and take a peek at how the indexes did today. The Dow Jones finished down 0.42 at 3967. S&P 500 actually finished barely up. It was down most of the day. Finished up 0.17 at 3831. Like I said, the NASDAQ had a really good day. It was up 1.75%. Closed at 11,322. Small caps were also up 0.63. The VIX was up most of the day. It was up almost 5% through most of the day. Wound up finishing down 0.11. It's currently sitting at 2750. Moving over to the other exchanges here in the Americas, Canada was down 1.02. Brazil down 0.38. Mexico down 1.01. Headed over to Europe, Germany was down 2.91, England, or the UK, down 2.86, France down 2.68, Eurostoxx also down 2.68, Netherlands down 2.33, Spain down 2.48, Italy down 2.99, Switzerland down 1.65, and Portugal down 2.89. Moving down a little further, the Russian exchanges were mixed. The MOEX was up 1%, while the RTSI fell 8.19% today. Not real good there for that market. Moving on over to the Asian markets, Japan was up 1.03, Australia up 0.25%, New Zealand up 1.25%. Headed over to the Chinese markets, the Shanghai was flat. It finished down 0.04. The SESE component down 0.41. China A50 up 0.05, the DJ Shanghai down 0.06, and the Hang Seng came in up 0.10, and the Taiwan weighted was up 0.93%. So it looks like the Asian markets were actually pretty decent overnight. It was the European markets that got clobbered. Most of them were down between 2 and 3%. And then here domestically, we finished out the day much better, certainly not as bad as it was most of the morning and early afternoon. But, again, still not too surprising. If you were watching on Friday's broadcast, I was showing how the intraday charts just don't look real good going back to the beginning of the year. And until we change the momentum of what's going on, I don't expect any major changes. Plus, looks kind of like, based upon all the writing on the wall, that recession is probably on the horizon. You keep, you inflate the money supply to a point where inflation is out of control, then your only next steps are to, start jacking up interest rates to bring inflation down. That's going to bring a screeching halt to the economy, which then, leads to recession. So, again, anyone who's actually cracked an economics book and knows a little bit of history is probably not real surprised right now. So, all right, let's go ahead and read through this week's weekly economic update. All right, for the week on Wall Street, stocks turned lower as a quiet news week offered investors little fresh visibility into the market overhangs of economic slowdown and inflation. The Dow Jones Industrial Average dipped 1.28, while the S&P 500 fell 2.21. NASDAQ dropped 4.13%, and internationals lost 1.49%. The rebound fizzles. Stocks struggled last week amid poor market liquidity, typical of the summer months, and a news vacuum ahead of second quarter earnings reports. Investors also appeared to be anticipating guidance at the July FOMC meeting. What little news there was proved generally disappointing. A steep decline in consumer confidence preceded Fed Chair Powell's acknowledgement that inflation may persist. Really, Jay? Shocking, Mr. Powell. Stocks stumbled after a profit warning from a high-end retailer, which highlighted recession risks. The sentiment suffered from a 4.7 increase in the core Personal Consumption Expenditures Index, which is the Fed's preferred measure of inflation. It remained near levels not seen since the 1980s. Consumer confidence wanes. The Conference Board's Consumer Confidence Index declined to its lowest levels since February 2021, falling from 103.2 in May to 98.7 in June. While consumers' assessment of current conditions slipped only marginally, their short-term outlook for income, business, and labor market conditions eroded substantially, touching its lowest level since March of 2013. The rising pessimism about the short-term outlook was especially notable in consumers' assessment of financial prospects, with 15.9% expecting their incomes to increase, down from 17.9% in May, and growing share of individuals expected their incomes to decrease, 15.2% in June versus 14.5% in May. All right, economic data coming out this week. Today on Tuesday, we have factory orders. Tomorrow on Wednesday, we have the FOMC meeting minutes comes out. Also, job openings and labor turnover survey, the JOLTS report, and the ISM services index will be out on Wednesday. Thursday, we have the ADP employment report and jobless claims, and Friday, the employment situation. Only one company is reporting earnings this week. On Thursday, we have Levi Strauss & Co. Reporting their earnings. All right. So again, not a lot of great news in the, coming out of the news streams. But again, not to be surprised. They are typically, like everything else, a lagging indicator of what's really going on in the world. So don't be surprised that you're going to read a lot of negative news coming across the news wires for quite a while until, things really start to turn around again. All right, let's read through today's market recap. S&P 500 cut some losses on tech bounce, but recession fears weigh. The S&P 500 cut some losses Tuesday, but remained under pressure as fresh warning signs of a possible recession spooked investors and triggered an energy-led rout on Wall Street. The yield on the 2-year Treasury bond jumped above the yield on the 10-year Treasury note, making a key inversion in the yield curve that usually signals trouble on the horizon for the economy. Yeah, I could have told you that back in 2019 when the yield curve inverted back then, that we were headed towards a big mess. Yeah, but, we printed up a lot of money and, staved off a market collapse at the time, but we'll eventually have to go through it and push all that malinvestment back out of the system and start back over. All right. Recession fears have been gaining momentum following the Atlanta Fed's GDP forecast calling for a 2% decline in the second quarter, following a 1.6% decline reported for the first quarter GDP. Another decline would place the economy in a technical recession. Quote, as investors return from the 4th of July holiday, sentiment remains uneven as market participants continue to ping pong between fears of recession and concerns over too high inflation, Stifel said in a note. Energy stocks were hit the hardest as oil prices slipped more than 9% on bets that recession would weigh on energy demand. Halliburton Hess Corporation were among the top decliners, falling more than 8%, while Occidental Petroleum fell more than 5%, even as Warren Buffett's Berkshire Hathaway increased its stake into the latter to 17.3%. The slump in Treasury yields hurt bank stocks with just over a week ago until major Wall Street banks kick off the quarterly earnings season. JP Morgan is set to report results on July 14th. As the fears of recession mounted, growth concerns of the market were the outperforming sectors on expectations that the Fed may not deliver aggressive interest rate hikes to bring inflation under control. Investors piled into beaten down retailers and cruise and casino companies to push consumer stocks up more than 1%. Norwegian Cruise Lines, Dollar Tree, Caesars Entertainment were outperforming, with the latter up more than 8%. Big tech was also in the ascendancy as investors led by Alphabet and Meta Platforms, despite Barclays' warnings of, quote, perfect storm in digital advertising amid rising competition and slow digital ad spending. Chip stocks also cut some intraday losses, even as investors continue to mull over Micron Technology's recent quarterly results that flagged headwinds for chip demand. In other news, Ford Motor fell 2% after reporting that sales rose 1.8% to 483,688 new vehicles in the second quarter from a year earlier, below estimates for a gain between 3.3 and 5.1%. All right. So again, not the greatest news. There's a lot of bad news out there in the markets, but again, don't really be surprised. I mean, this was on the headline, or this was in the tea leaves a long time ago. And if you're caught off guard by this, I really don't know what to tell you at this point. All right. Next article comes from Zero Hedge. If central banks do not tackle inflation, deflation will come from a crisis. Most market participants have been surprised by the last 6 months, not me. The total return of the U.S. Treasury Index was the worst since 1788, according to Deutsche Bank. Stocks closed June with one of the largest corrections since 2008. Bonds and equities are falling in unison, driven by rate hikes and normalization of monetary policy. The balance sheet of the main central banks has barely moved and remains at all-time highs, according to Bloomberg. The ECB continues to ignore the highest inflation rate in the Eurozone since the early 90s by keeping negative rates. The Federal Reserve rate hikes have been more aggressive, but still injecting billions of dollars into reverse repo market, and monetary aggregates remain excessive. M2 money supply has risen to $21.8 trillion. A yearly change shows a rise of $1.3 trillion, which is more than double the annual figure of the expansion phase of 2008 through 2011. Money supply, M2, annual growth in the United States was 6.5% in May and 6.6% in the Eurozone. Global monetary growth in May was 9.9%, all figures according to Yardeni Research. In the Eurozone, money supply growth is higher than in the middle of the so-called Draghi bazooka, the famous, quote, whatever it takes. We already explained in a previous article that commodities do not cause inflation, money printing does, and the monetary aspect of inflation is not being properly addressed. One or two prices may rise due to an external crisis, but the rest would not rise in unison given the same quantity of currency. Between 2012 and 2014, we saw energy commodity prices soar, yet inflation measured as CPI was low because the supply of currency was in line with demand. We did see enormous inflation in asset prices, though, and policymakers did not pay attention to the impact on house prices and markets of enormous liquidity injections. When newly created currency stopped going to risky assets and was targeted at government current spending, inflation shot up. However, it is better to create a correction in bonds, equities, and risky assets after years of all-time highs than to lead the world to a crisis created by the destruction of purchasing power of salaries and deposits. The pace at which they bloated their balance sheets and cut rates is what should have been worried about, not the normalization. Consumer confidence is plummeting around the world. Real wages are negative, and families are consuming the little savings they had just to make ends meet. At the same time, businesses are struggling with weaker margins as input prices soar. The worst thing that governments and monetary authorities could do is to let the economy slip into a crisis where the productive sector, families, and businesses collapse just because they did not want to cut deficit spending and truly normalize monetary policy. By then, the problem will not be inflation, but deflation coming from the asphyxiation of the private sector. Once consumers and businesses fall, tax revenues will also plummet, taking government debt to new highs. Even Keynesians should be worried about letting inflation run wild, because the result would be that governments face an even worse fiscal crisis when the private sector slumps. Inflation can be addressed by properly reducing the central bank's balance sheets, raising rates, and cutting deficit spending. If policymakers send the private sector to a crisis due to inaction, the crisis will be far worse than 2008. It is still time in the perverse incentives of excess monetary action. It may create another leg down in markets, but they will eventually recover. The destruction of businesses and families' disposable income is far more challenging to restore. And I do agree with that. I mean, they've been talking a big game since last fall that we're going to, increase rates, we're going to slash the balance sheet, we're going to stop the quantitative easing and begin quantitative tightening. And to this point, they haven't done anything really other than, bringing rates from, basically zero up to 1.5% at this point. Inflation is running over 8%. So, again, that's kind of like throwing a bucket of water at a forest fire and expecting that it's going to solve all the problems. Just talking about it isn't going to do anything. I mean, our governments need to stop spending like drunken sailors. And as a former drunken sailor, I find what they're doing offensive. And, jack up rates. And, yeah, it's going to be painful for a short period of time, but at the same time, would you rather have this drag on for a decade, or would you rather deal with it for 6 months and start over again after you've flushed out all the malinvestment in the in the markets? So, but again, that's just my opinion. What do I know? All right, one last article here has to do with our buddy Paul Krugman, who, if he wasn't wrong about stuff, I don't think he'd be right about anything. But this comes from Mises Wire at Mises.org. Some of the smartest people in the world right there. Krugman is wrong again. Artificially low interest rates created bubbles. In his June 21st New York Times article, quote, "Is the era of cheap money over?" End quote. Paul Krugman again argues against the view that the Fed has kept interest rates artificially low for the past 10 or 20 years. Other commentators have argued that these low interest rates have inflated bubbles everywhere as investors desperately look for something that will yield a decent rate of return. Krugman expresses a strong disagreement with the decline in interest rates caused bubbles, and that the decline was artificial. For Krugman, the Federal Reserve set short-term interest rates, which in turn determine long-term rates. He then suggests that there's no such thing as an interest rate unaffected by policy. The columnist then argues that what matters for the Fed's policy is the natural rate of interest, which is consistent with price stability and economic stability, i.e. economic equilibrium. This means that the key objective of the Fed policy should be to target the policy rate to the natural rate in order to attain the state of equilibrium. Given that the natural rate was trending down, it was not surprising that the policy rate followed suit. Why has this natural rate been trending down? According to Krugman, the downtrend was caused by demography. Quote, "When the working age population is growing slowly or even shrinking, there's much less need for new office parks, shopping malls, even housing, hence weak demand." Krugman warns that these demographic forces aren't going away. If anything, they're likely to intensify, in part because of the rate of immigration has dropped off. So there's every reason to believe that we'll fairly soon go back to the era of low interest rates, end quote. Krugman also says that the Fed's interest rate policy has been in line with the neutral rate, which fell sharply again. Again, the key reason for this decline is aging population and reduced demand for investment in the infrastructure. However, does this make sense, or does it all make sense? According to Krugman, the Fed is the key factor for determination of interest rates via its control of short-term interest rates. The Fed's influences short-term interest rates by influencing monetary liquidity in the markets. Through the injection of liquidity, the Fed pushes short-term interest rates lower. Conversely, by withdrawing liquidity, the Fed exerts an upward pressure on short-term interest rates. On this thinking, long-term rates are the average of current and expected short-term interest rates. If today's one-year rate is 4% and the next year's one-year rate is expected to be 5%, then the two-year rate should be 4.5%. Conversely, if today's one-year rate is 4% and next year's one-year rate is expected to be 3%, then the two-year rate should be 3.5%. On this logic, it would appear that the central bank is the key in interest rate determination process. However, is this the case? We believe it is individual time preference rather than central bank that hold the key in the interest rate determination process. What is it all about? An individual who has just bought enough resources to keep himself alive is unlikely to lend or invest his paltry means. The cost of lending or investing to him is likely to be high. It might even cost him his life if he were to consider lending part of his means. Therefore, he is unlikely to lend or invest even if offered a very high interest rate. Once his wealth starts to expand, the cost of lending, investing starts to diminish. Allocating some of his wealth towards lending or investment is going to undermine to a lesser extent our individual's life and well-being at present. From this, we can infer, all things being equal, that anything that leads to the expansion in the wealth of individuals is likely to result in lowering of the premium of present goods versus future goods. This means that investors are likely to accept lower interest rates. Note again, interest is the outcome of the fact that individuals assign a greater importance to goods and services in the present against identical goods and services in the future. The higher valuation is not the result of capricious behavior, but because of the fact that life in the future is not possible without sustaining it first in the present. Hence, various goods and services that are required to sustain a man's life at present must be of greatest importance to him than the same goods and services in the future. And that goes into high and low time preference. If someone has a low time preference for something now versus a high time preference for something down the road, it basically means that the higher time preference is of a higher importance. So when people have a low time preference for things today, that means they're willing to defer gratification until a later date. So where was I? The lowering of time preferences, i.e. the lowering of premium of present goods versus future goods, is due to wealth expansion. It is likely to become a manifest by a greater eagerness to invest wealth. With the expansion in wealth, individuals are likely to increase their demand for various assets, financial and non-financial. In the process, this raises asset prices and lowers their yields, all things being equal. As a rule, a major factor for this discrepancy between observed interest rates and time preference interest rate is the actions of the central bank. Again, by popular thinking, the neutral rate is one that is consistent with stable prices and a balanced economy. Hence, by this thinking, in order to attain economic and price stability, Fed policymakers should navigate the federal funds rate towards the neutral rate range. By the neutral interest rate framework, in order to establish whether monetary policy is tight or loose, it is not enough to pay attention to the levels of monetary market interest rates, but rather one needs to contrast money market interest rates with the neutral rate. Thus, if the market interest rate is above the neutral rate, then the policy stance is tight. Conversely, if the market rate is below the neutral rate, then the policy stance is loose. Hence, whenever the money market rate is in line with the neutral rate, the economy is in a state of equilibrium, and there is neither upside nor downside pressure on the price level. In the popular framework, the neutral interest rate is formed at the point of intersection between supply and demand curves. The supply and demand curves are presented by popular economists originates from the imaginary construction of economists. None of the figures that underpin these curves originates in the real world. They are purely imaginary. According to Ludwig von Mises, quote, "It is important to realize that we do not have any knowledge or experience concerning the shape of such curves," end quote. Consequently, this implies that it is not possible to establish from imaginary curves the neutral interest rate. The employment of sophisticated mathematical methods does not solve the issue that the neutral rate is not observed. So what are the basis for Krugman to suggest that the neutral rate has been trending down? None whatsoever. Contrary to Krugman, the Fed, by being a major source of money creation, has been instrumental in the formation of bubbles. And in conclusion, contrary to Krugman, the main source for money creation, quote, out of thin air, is the central bank. Consequently, various bubble activities created are the outcome of the Fed's monetary pumping and nothing else. All right. I know it was a bit long and a bit wordy, but again, it's important to understand that most things in the economy are driven by needs and wants. Unfortunately, most people make their financial decisions more on wants than on needs. But, because most of us need income or need a way to take care of ourselves when we get old, but we focus more of our attention on the wants of today and spending all that money before we ever have a chance to really save it up. So, all right. Well, that's everything I had for today. If anyone has any questions or comments or would like to reach out to me, please go to dsafinancialgroup.com. All my contact information is there. I'll be back tomorrow with the Liberty Call for Wednesday, and hope everyone has a fantastic evening. Bye-bye.